All right, so I'm back from vacation after about a week or so, and the markets really didn't do much of anything, but today had a little bit of a change in sentiment and directions. So I'm going to break down kind of the change in some of these indicators that we've seen after having been relatively bullish up to the time I left, and even for most of that week I was gone, staying relatively bullish. But in the last few days, and especially today, a little bit of a change in sentiment. So I'm going to break that down. Some big moves in different asset classes and pretty significant moves. So we'll break that down as well, especially in, like I said before, in bonds, and the dollar is showing an interesting move as well. So we'll take a look at that. And then we are making a big push on our YouTube channel to get up to 10,000 subscribers. We're about 7,000 right now. So if you're watching us on YouTube, I invite you to subscribe with us channel. I share a little bit later on how to do that. Subscribe to our channel. Let's try to get to that 10,000 mark. That's our goal for us. And if you're watching, we'd love to have you subscribe. And if you're subscribing, there's a little bell next to there where you can get notified, usually by an email or some notification when these videos get posted. With that said, let's go ahead and get started. Today is Wednesday, April the 12th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. As I mentioned before, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, you can check out some of these other things on our site on the right, including our Market Outlook live videos I do at 3:30 Eastern Time. Come down here, click this heart. It opens up this tab. Hit that like, eventually. Hit that like button right there. Click this thumbs up icon as well. It takes you to this tab, eventually, where you can hit that like button as well on this tab. Again, the more you do that, it helps get our content out to all of our followers. Is what we always ask for. We got 116, which is outstanding. Thank you all very, very much for doing that. And again, thank you to those who like us day in and day out on those platforms. It helps more than you know. And again, those who don't, you can do right now while you're watching, just with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see a down day today, a second down day in a row, though, I mean, it's kind of hard to call that a down day yesterday, but it was by technically. A little bit more of an engulfing pattern even today, engulfing the body of yesterday's little doji, and then being an outside day, the range, engulfing the range from yesterday as well. As a result, it's not surprising to see the momentum line and the near-term line come down. The near-term line forming a little bit of a bearish peak here, like barely getting above 80 and then not staying up there for very long, just a day. You like to, if you're going to be bullish, you like to be up there for a while. And, 7 to 12 days, with most of them being in the upper half of the chart, with most of them being above 80, but it's the ideal scenario when you're bullish. So the fact that we're kind of getting a lower peak, and already coming out after a day with a momentum line that's dragging that down, and as well as getting closer and closer to the 30-day moving average. We're still more than 2% above it, but getting a little bit closer. It's a little bit more of a down day than what we've seen here recently. Before we had been opening lower and then rallying, opening lower, rally, open lower, rally. Today we opened up higher on that CPI data and then just fell all day long through the FOMC minutes. So we had a little bit of an upward swing, but then fell after the FOMC minutes were released and ended up coming down. So that's the SPX. Looking at the NASDAQ 100, it's even more of a bearish peak on the near-term line because it didn't even get in the reversal zone, and it's already in bearish territory with an extremely oversold momentum line. You're looking at the Russell 2000. Even more extreme on the momentum line. The near-term line got higher, got up to the 90th percentile, so it got to extreme highs, but again, only a day suggests that that's bearish and a little bit more of an engulfing pattern, a little bit bigger range as well, almost average range on the Russell 2000. And then finally your Dow Jones Industrial Average, which has been so bullish here in the last week or so, last 2 weeks, forming a near-term divergence here with a lower peak on the near-term line that's also already out of the reversal zone with the momentum line dipping. So you can see kind of the weakness showing up in the charts on the different market forecast patterns. What really stands out on is, and I know we have 2 more days left, but what really stands out to me here is the weekly chart. You can see the momentum line is really diving. Didn't even come close to where the near-term line peaked, and it's already down to close to extreme lows, well inside the oversold zone. That suggests a very, very tenuous and near-term line. Very tenuous there. It did get to extreme highs with those 3 really strong weeks. Boom, boom, boom. And then now with 2 really small ranges, I mean, that's what bringing the momentum line down. And the near-term line, just it's hard to stay up there without the momentum line making a similar push. In the intermediate line, you can see also turning higher and trying to get into that upper reversal zone, because you can see when the intermediate line gets in the reversal zone on a weekly chart, it can stay there for a very, very long time. So, I mean, like, we really want to see, if we're going to be bullish going for the rest of the year, we really want to see that get above 80. But you can see this divergence between the momentum and near-term line suggesting that it's going to be hard to do. Not getting a lot of follow-through like we'd like to see. So it'll be interesting to see how we finish the week here. Whether or not, if we end up more bearish by the end of the week, that could really throw a wrench, which is what this pattern would suggest. That could throw a wrench into the bullishness. The other thing too on the weekly chart that stands out, skip the chart here, is where we're closing. So we're actually getting a lower close from week to week. We've already, the Hakinashi, the size of the candle has already dropped to being below the 3 period moving average, which is the purple line. That typically signals a change in trend on a Hakinashi differential. Remember the trend. It's not as choppy as you can see the regular candles are, so it smooths out the trends, so we can kind of see when we get the reversals. And considering the lower close, we did get a slightly higher high, but only by a little bit more than a point. But as of right now, a lower close. Again, 2 more days left. And then the break below that suggests that we might be in reversal pattern mode right now. That we might be forming a transition, which again would suggest we might end up with a couple more days of weakness here. Remember, we have bank earnings on Friday morning before the open that could create some volatility for equities. We also obviously have 3 green arrows on the S&P and the diamond. We do not have it on the Dow, NASDAQ, unfortunately. We have 2 red arrows, so we don't have the green shading. Remember, we never did get the green shading on the Russell. We did have the 3 green arrows here. At least we did have the green arrow on the. We didn't have the green arrow on the stochastics. We got it today, and we also got the. We were at the highs. We had a green arrow on the moving average. We had a 3 green arrow signal there, which would have produced a bear tag, and in fact it did produce on an intraday basis. The bear tag here didn't stay because we didn't close above that line, but briefly we had a bear tag on the Russell 2000. So, which also means we had 3 green arrows on the Russell 2000 as well, with the green arrow coming back on the stochastics. Doesn't look like we're going to get that. We'll see, right? We'll see, but as of right now, it doesn't look like we're going to get that. Another reason why is because you can see the MACD is close. Remember, the MACD already is red on the Qs. So at best, the Qs are forming a convergence period, or entering a convergence period at major resistance levels with these Fibonacci lines. It's going to be hard to really maintain bullishness when you're entering convergence before you break through resistance. And that's convergence here, meaning that you're below the moving average on the MACD, but you're still slightly above that 17-day moving average. You're not quite below the moving average yet, which is what the red arrow on the MACD, but you can see how close we are, again, before some major, significant narrative altering levels here. And then, of course, looking at like IWM, which never did get 3 green arrows, never did get above the 30-day moving average. And you can see also close to getting a red arrow on the MACD without it ever even getting above 0. Which goes to show just how bearish this is. And the Russell actually did slightly close below the 17-day moving average. The Qs are almost there. The diamonds are nowhere near the 17-day moving average. Though it is the MACD histogram is coming down, so you're close to a red arrow, which would also mean you're also close to some pretty significant resistance with this volume node here. and the 62% retracement that we've been trying multiple times to get above and stay above. Briefly there in August, better in November, and then in February, but then now here trying to make another run at it. So big time resistance in this area, and again, approaching a convergence period there too, heading into major resistance. So you see a theme developing on these. Let's look at some of the other oscillators. The S&P, you can see that the positive indicator is dropping. It's now back below 30. Hasn't dropped below 25 yet, so we're still okay. And your negative indicator is starting to rise up a little bit. Remember, the IWM and the Qs have been more bearish. You've already got the cross on IWM, at least to the upside, but it looks like, again, the positive indicator may be hitting some resistance there. The Qs, on the other hand, which has been so bullish, had such a big peak at the, we were up above on that. Now you can see how we're just that close to not being in a trending mode anymore. You see that reflected also in the RSIs and the CCIs. We're back below 60. We're not below 0 yet on the SPX, but look at the NDX and you're pretty darn close. Looking at the Russell, and you can see you never did get bullish. And of course your diamonds, your Dow Jones Industrial Average, is still actually pretty bullish. It remains the strongest of all the indexes there. Let's take a look at another kind of sign of convergence is we are trading below the 20-day hull. It's still green, so it hasn't turned red yet, and it hasn't turned into a bearish candle and haven't flipped a parabolic SARS to the upside. But you can see how you are breaking below the moving average of the MACD. This is the MACD of where we are relative to the 200-day hull, which has turned green. So you are starting to show some weakness there. You can see the Hakinashi candles as well getting smaller, but the key is that we're below, and you can see when you get below, you start trading below, that's a period of convergence that can ultimately lead to some bearishness if we stay in this period for too long. So again, you see the theme developing of convergence here. You're not below the moving average yet. You're still in pretty strong levels from a 4-day range, but we're not. We still haven't developed even an intermediate level strength trend here. You're above 50, you're above 1, but you got to get above 2. You got to get above 65, and we're just not there. And you can see we have a positive rate of change. It's very minimal. It's going to get a lot bigger if we go flat from here because the price 26 days ago really drops. But it kind of shows where we can go if we follow that pattern from 26 days ago to keep the rate of change at relatively low levels. Looking at the McClellan oscillator, we actually had a pretty strong day early, but by the end of the day, you're almost back below that 35 level. So again, it's kind of showing the lack of breadth you like to see to really continue to push higher. You also see that in the money flow as well. You're not above 60, you're above 50, but you're not above 60, so you're not getting strong money flow to really push to new highs, which is kind of what you need to see. And then finally, from a Bollinger Band perspective, you're not in the upper quartile anymore. You never did get above the Keltners. The bands are going to start, you see the momentum has already started to shift to where you're losing that positive momentum, and without getting above the Keltners is not necessarily a good sign. You like to be able to maintain good momentum on these trends by pushing above the Keltner channels, and that really maintains that positive momentum on a good trend to the upside or to the downside when you're looking at it from this perspective, and we're just not doing that. So clearly showing some weakness here, and at best you could say that we are entering a convergence period where, again, it doesn't mean we can't go up, it just lacks that strong momentum. And when you're sitting at major resistance levels, you kind of need strong momentum to bust through these things. Now the question is whether or not we'll enter more of a divergence period, or in other words, more of an impulse move back down to the downside. We may be a few days away from that happening because convergence periods can last a few days. So we'll see how long we just kind of grind before whatever catalyst may be developed that changes that momentum, in this case, from positive back to negative. But you probably need some red arrows, which are red dots first, which means the bands get inside the Keltner channels, which typically happens during a convergence period. and then you get your reversal. But you can see how much room you have to work with before you even get close to the lowest quartile. You'd have to get below the point of control to get below the lowest quartile, and that's not going to happen by the end of the week. Most likely won't even happen like by next week. So it's that, again, we're not talking about the markets tanking in the next day or two, but you can also see how we're just losing what we really need. We need breadth, we need momentum, we need push, so we need escape velocity to get out of this sideways action, and we're losing it. We're losing it as we head into major resistance, which we've seen before, which typically means that resistance will hold, because you expect resistance to hold until it doesn't, and there's a very good chance that it will happen again too. Remember, I pointed out to you previously these gaps from back here, common gaps that we saw. I mean, look at this range over the last, we got a slightly higher high today, but pretty much we've been in the same range for 2 weeks now, barring a breakout. And that's a pretty significant move. Yes, we did get a new jump to 100 because we got a slightly new higher high today, but the range is not, breaking out. And you can kind of see here, if we were to break down below this level, you can see the gap in volume that would get us down to that 395 pretty quickly, and then ultimately fill in these two common gaps, fill that one in, finish filling in this one, and then this gap over here, which would be a very, very weak runaway gap if ultimately we do break out to the upside. But more than likely it's not, and because it's so weak, it's more likely a common gap, and more likely we'll fill that in as well sooner rather than later. Looking at today's range and volume, you can see that the volume picked up. It's the biggest volume we've had in a few days. Still below average, though, at 86 million. The range picked up, but still slightly below average. So bigger numbers than what we've seen in the last so many days, though those numbers are still lower than the average. So these lines are coming down. You can see the ATR relative to the price is really down. So the ATR is at its 52-week lows. The ATR relative to the price is at 1.25%. So I mean, we are set up for a broadening in volatility and expansion. You can see the VIX and the VVIX are down below 50%. That usually precedes a jump in volatility. The VIX is down, was down today slightly, just 0.05%, but it's really down relative to its average values, especially over the last 200 days. You can see, if I were to show you where that VIX is relative to its 200-day average, it's way down. You can see we're above the moving average now. We were in the 10th percentile, below the 10th percentile. Now we're in the 12th. So I mean, we are set up, and the stochastics is lower than any of these other periods. We are set up for the VIX to make a jump to the upside. I showed today in our class the tremendous move to the downside in volatility, this expiration cycle after gapping up when the cycle began. That's a pretty strong move. We opened up at 27. We're closing right now at 19. That's one of the bigger ranges that we've seen in a while. The last time we saw that was kind of over here in September, and then that led to three consecutive bullish expiration cycles in volatility. And that's the kind of pattern that I expect that we'll see again. Breaking down this one, we actually broke well below 20 and closed at 16 before finishing the year closer to 30. This one, we're closing at 19. You would expect if we were to get a more of a trending move to the upside in volatility, it's probably going to end up a little bit higher than 30 the next go around. All right, now let's talk about what's driving this price action. You can see everything started off pretty strong. The NASDAQ started off high. IWM started off high, almost 1% higher. EFA started off high. Gold, real estate, anything physical, commodities, all started off the day really well. Anything paper, treasuries, the dollar, all down pretty significant. Emerging markets struggling too, interestingly enough, with the weakness in the dollar. The dollar stayed down all day long, but by the end of the day, the Qs went from one of the highest opens on the day to the lowest close on the day. IWM went from, again, almost the highest open on the day to almost the lowest close on the day. So big turnaround Now, granted, we're talking like less than 1% on the opens and less than 1% on the closes. But still, it's a pretty big turnaround. And bonds started the day flat, ended up pretty weak at the lows of the day, and then almost finished flat again. So not quite the turnaround. Ended up, starting flat and finishing flat. Gold started strong, finished strong. EFA also stayed strong throughout the day, and so did commodities. Kind of a reflection of the weakness in the dollar benefiting those areas, even if it didn't benefit necessarily emerging markets, which really struggled. High yield outpacing treasuries too, which is kind of a risk-on relationship there. Now let's take a look at some of the charts for those different asset classes, especially the dollar. Remember, the dollar made that big move to the downside. You can see breaking down below its 8 and 17-day moving averages again over the last couple of days. The 30 is about to break below the 50 and the point of control. Like, we are making a new leg lower. Now, that's been bullish in the past. Probably not going to be the most bullish going forward for the currency. You can see it's had its bullish run. Remember, the cycle is currencies, bonds, stocks, then commodities. So the currencies have had their bullish run the currency did over this last whatever period. Bonds haven't had their bullish run yet, but they are so close to breaking out. We've been talking about this. But before I left, we talked about how it was kind of on the cusp of breaking out over here, right at the 200-day. It actually did get above, but didn't break out of this range before pulling back. We're still at the 17-day moving average. We're still kind of flirting with breaking the 50-day moving average, which again we were breaking above before I left, and now we're kind of flirting with that. Like it's flirting with starting its bullish move. But again, the thing with bonds and their bullish trends, they occur during correction/bear markets. Since we've already had our correction, and without a bullish move in bonds that preceded it, or that coincided with it, which typically happens, you can see, like, for example, going out to 2018, here's your increase in bonds as we were falling. Stock prices were falling during the fourth quarter of 2018 during the last kind of normal correction that we had there. But then you can see the big rally in bonds that preceded the big rally in stocks that came off of the COVID low points. So to get a big rally in equities, we need a big rally in bonds to precede that. And so far, that's all we got. That's all we got off of that low point. We haven't even gotten above the two. I mean, bonds technically are still kind of flirting with their 200-week moving average, well below, the 200-week moving average. So they haven't even started to fill in that gap there to end its bear market before it can even start a bullish move. So again, stocks or currencies, bonds, stocks, and commodities. And commodities, remember, are just correcting, right? They are in a correction mode, and now we're up at that 30-day moving average above the 17 this week. But you are in a gap in volume. You are below the 30-week moving average. You are below the 50, so you are in correction mode, even if over the last 4 weeks we've had a pretty good run, which is not going to do good for headline inflation, which is everybody so keyed on, which came out today. It came out much lower than expected, and that's actually driving the estimates for the PCE now much lower than where it was, closer to 0.3. The core is still pretty darn high, and that was the theme of today's report as well, that the core CPI remains really strong and is expected to, and even the headlines expected to go up next time at the May reading, which actually will come after the next FOMC meeting, which as of right now, widely expected to raise interest rates. You can see going into that May meeting, we're at 65%. We're flirting with 70 all day long. Here in June, you're looking at about a 70% odds of being at 5.25% or higher in June. In July, those odds start to drop. You're only at 31%. So you have a 65 to 70% chance of being at 5.25. That drops all the way to 30% in July. So if we do get a rate hike, the market's expecting a rate cut very rapidly. But 5.25%, you're at 10% odds of being at 5.25 in September. So you go from 65 to 70 down to 30 down to 10. just like that. So if we're going to get a rate hike, the market's expecting a rate cut just as quickly. You can see it's down to 3% in November, and then by December, the odds of being at 5.25% are only at 1%. So very, very low odds. Now remember, the Fed has mentioned, even if no one believes them, but they have mentioned, and they should be more believable because they've been doing what they've said for the past year. But they have mentioned that they want to get rates high, relatively high, and so they're almost to a positive real Fed funds rate. They're so close to a positive real Fed funds rate. That's how close they are. They're at 0.33%. And obviously, by the time they get another rate hike at 5.25%, they will be now slightly positive when they get that rate hike in May. Of course, the next CPI report sees at 5% right now, this current year over year. But remember, the next one, see at 5% there, the next one's actually is anticipated that it will jump up to 5.12. So it's going to be right around positive, but and the Fed in the past has stopped raising rates when they got to 2.5% positive real Fed funds rate. In 2018 and 19, it's kind of throwing some people off because it got just barely above zero, and the Fed got really, really nervous and started cutting rates. You had an inverted yield curve. They started cutting rates there. It's a different time and a different policy. So a lot of people expect the same thing to happen, and the markets took off after they started cutting rates, which is why you have like the Tom Lees of the world, or who don't really pay attention to like all of this because their recency bias tells them, hey, it's going to be exactly like the way it was last time, which is the one time that the Fed cut rates without without the beginning of recession. And so even though they did slightly get a small one with the COVID, but that was obviously an anomaly there. But they barely got above zero. They cut rates. They had a small inverted yield curve. We obviously have a much, much bigger inverted yield curve right now, which is a reflection of the Fed being willing to get it up higher and keep it there for a much, much longer period of time. I mean, that's record lows on inverted yield curve between the 10-year and the 3-month, which is pretty much the effective Fed funds rate, the 3-month yield, which you can see is just hovering right around 5% and will gradually move a little bit higher as we get closer to that May, if they raise rates. Of course, the 2-year is saying, again, is pricing in the rate cut. So the betting market, the futures market, and the bond market, you can see you're at 4%. So the 2-year is also anticipating. But again, if we get rate cuts, and I know this is not what you hear on TV because they're very much a recency bias to that 2019. They haven't, I mean, as professional as they are and as smart as they are, they're a little amateur in how they're looking at things because I think they're playing up to what people want to hear on TV and maybe what their the sponsoring institutions want to hear as well. But the reality is the Fed has said higher for longer, which means if they cut rates by the end of this year, it will be because the market has broken down, right? It will be because the markets will not be above the 200-week moving average if they cut rates, right? If we stay above these lines and start to trend higher, they won't cut rates all year long. That's actually the best case scenario. That's the bull narrative. If we get back up to 4,800, it will be because they're not cutting rates. They won't cut rates up here, and that would be a great thing if the market can handle 5.25% interest rates overnight without causing recession. I mean, how much more bullish can that be, right? That's actually the best case scenario. Earnings, this would be a big earnings driver. Valuations are already really high, so it can't be valuation expansion. It would actually be earnings growth. And again, how much more bullish can that be if the market at really high valuations can now start to support that with earnings growth and at 5.25% overnight interest rates? That's the ideal scenario. Obviously, that's going to be very hard for that to happen. It's very low probability of that happening, which means more than likely we'll break that 200-week moving average, at which case when we're down here near 3,400, that's when the Fed will start cutting rates. And again, once we get below the 200-week moving average, like we already are in IWM, then that means we're transitioning now from what was a bull market correction when you're above the 200-week moving average and you hit it and you bounce to the beginnings of a bear market. And a bear market, again, my definition of a bear market is once you break that 200-week moving average and you have an extended period below it, like this one. In fact, you can really see it with the PPO here. When you extend below the 200-week moving average for an extended period of time, that's a bear market, right? So that's a bear market. That's a bear market. This is somewhat of a bear market. Again, valuations were so low to begin with at that peak. They were below 10. The cape was below 10 when we got to that peak right there. So it's kind of hard to have too big of a drop when valuations are already really low. But then over here you had high valuations and you can see the drop. That's a bear market, right? So, you get below the 200-week moving average, stay below it, then that's when, that's the beginning. So at that point, if we're down here to 3,200, that's going to be the point where, and here, let me bring those Fibonacci lines on. That's going to be the point where the Fed in this area here will start cutting rates. And again, by the time you're in this area here, if we get to this area, we'll already be in a bear market. Just like 73, 74, when they started cutting rates while we were already in the bear market. Whereas all the other time they cut rates was at the beginning of the corrections. In this area is when they cut rates before, either here or here, in prior bear market cycles. They cut rates at the beginning of the corrections, either before they started or right after they started. This would be similar to the 73, 74 bear market where they hiked rates during the correction and then started to cut rates after the bear market had started. I see a very similar scenario. Again, if we're cutting rates, it will be because we're down here. If we break 4,200 and we do make our way up towards all-time highs, they won't be cutting rates. So I think if you're bullish in the long term, and we all are, right? Because all of our long-term portfolios are positive deltas. If we're bullish, then you do not want rate cuts. You want all of these numbers to shift their way down. The problem with that scenario is that also will mean that the yield curve will uninvert, and it will uninvert with the 10-year rising, not the 3-month dropping, but because they're not cutting rates, but the 10-year rising. And the reason why the 10-year yield would be rising in that scenario, if we're making our way back up to 4,800, is because at the same time, we'll also be getting a new peak in inflation, which the fear is, and this is the Fed's fear, getting the inflation rate down is the easy part. And again, it's so like naive and almost bordering childish for people to be so happy about the inflation level coming down here from an investing standpoint. Obviously, we all want it to come down, but from an investing standpoint, it's like, ooh, the inflation level is coming down to 5%. Well, yes, of course. Look at every single peak and how fast it comes down. That's not the issue. The issue isn't getting it to come down. The issue is getting it to stay down. As you can see, you tend to get higher peaks. You tend to get higher peaks. So it tends to trend up. And here we were trending lower, and we got this peak. And you notice this peak, unlike all the other peaks above 5%, is not in a shaded area, which means that all these other peaks that also occurred and that didn't occur in shaded areas, they typically got higher peaks that came after them that did occur in shaded areas. So if we are going to make our way back up to 4,800, more than likely inflation is going to stop dropping. It's going to turn back up again. Commodity prices would be rising, of course, right? Because they are lagging. They would make a new run up to old highs, if not higher. We would get a new run in inflation, potentially up to a higher high than even that, because that's the trend. And then that will be the peak that ends up being in this shaded area. Or like 1950, we get the shaded area coming after inflation just drops like a rock, right? Because the Fed, which is what they prefer, breaks all this speculation with the rate hikes they currently have, and inflation drops because the market has gone into recession, as you heard a little bit of today. And then again, the Fed would be cutting rates at that point. Again, most likely by. So I think that latter scenario, that's the likely scenario. I think it's unlikely we get back up to those all-time highs. But again, if we do, it will be because the Fed is not cutting rates this year. It will not be because they are. Again, if people say they are, it's because they have a very significant recency bias to the one time that the Fed cut rates and the market kind of took off after that here without any kind of recession forming. But again, 2019 right there, by the time we got to August 2019, we had that peak in inflation at almost 3%. But by the time we got to August 2019, we were back below 2%. Hence why the Fed could cut rates, right? And you saw where the real Fed funds rate was in August of 2019. It was positive. So the Fed could cut rates. Inflation was low. Inflation is not at below 2% now. The real Fed funds rate was a lot more negative and is not even positive. So again, can't cut rates like 2019. There can't be a mid-cycle adjustment. They're going to keep it higher for longer. In my opinion, if the Fed's going to err, they're not going to err on cutting rates earlier than they think they should. They're going to err on cutting rates a lot later than they think they should, because they don't want another peak in inflation to come at a higher level than what we just barely got. I think they want this level to occur with a really short. Now, granted, we did get multiple inflation periods of recession, but that's kind of what they would prefer, is for inflation to come all the way back down, stay down, little bit of a recession in there as a result, but nothing too major, and we can survive that without a new peak or even a new peak coming like we've seen in some of these other periods. This was actually the 73, 74 recession, and of course the new peak that came in the late 70s. All right, let's take a look at the sector moves. Let's bring it over here. Here we go to the sector comparison chart and look at, again, you can see the big 3-month returns in the QQQ sectors, but let's take a look at how things performed today. Again, the last couple of days, it's been all about industrials, financials, materials, and energy. They started the day pretty strong. By the end of the day, your 3 QQQ names just really struggling. Not surprising. I mean, they've had the biggest gains off of recent lows, but they're really coming down pretty hard here today. And so it kind of goes to show that that's why we're not seeing the strong breadth like we need to see. As you can see here, let's see if this is updated yet. Yeah, so this is now updated with the NASDAQ as well. New York Stock Exchange, both combined. We're still at negative. We're above the moving average, but you're still at negative levels. Your skew is also still below its moving average, and you're not, you're still kind of negative down there. You haven't broken down, but you're negative there. When you look at how many stocks are up above the 50-day moving average, which is right here, we're kind of at resistance at that median, at the 2-year mean, at right around that 50%, slightly above the 50%. I mean, that's about as average as we can get. Your average price deviation from the 50-day moving average is right at 0. So you're pretty much, the average stock is at its 50-day moving average. The half the S&P is at its 50-day or above its 50-day moving average. The other half is below it. Of the stocks that are below it, you're at 20%, which you can see is typically a peak in bullishness. It can be a low point in bearishness, as you can see a couple of times here in 2020. And so coming off that that late March peak there. So again, that can be a support. So you can see all these levels are kind of breadth levels, are kind of at areas where we can get a reversal here. We're not getting the slam, the thrust, the momentum, the escape velocity to break out of this kind of sideways action that we've been in, centered around 4,000 plus or minus 100 to 200 points for the last so many months. And now you're at the top end of that range. You're starting convergence periods. You're getting that shift in leadership where the QQQ names are now not leading, which is ultimately showing itself up here in weakness on the Qs relative to IWM, which typically is pretty bearish for the markets when this starts to fall back down. All right, now let's take a look at our trade idea of the day, and then I'm going to take a look at NVIDIA, which has kind of been the poster child of this year-to-date move on the market. It's up 80% year-to-date, 81% year-to-date. Obviously, it peaked at 280 a week ago, and it's been relatively weak since. Didn't quite get a cluster, got a cluster way over here, but you can see it's been dropping, and it got even more of a bearish near-term peak than the S&P is getting, with the near-term line, with the momentum line extreme lows, near-term line back into bearish territory after not even getting in the upper reversal zone. And you can see the convergence of with the moving average now only 3.5%, which is actually a very small number, relatively speaking, to where it's been in the past. So very significant change in NVIDIA. You can see, it's been a huge golden cross here, but you can also see a much more significant transition candle here with lower close, a lower high point. This is what the actual candle looks like. So it's not as bearish as it could be, but you can kind of see how it is shifting to more of a bearish move. It's, last week it's Heikin-Ashi differential broke below its moving average, so you're in the mode where we're transitioning towards more bearishness. The question is how much, right? Well, let's take a look at just how bullish it's been. You can see it's got 2 red arrows, so we don't have the green shading anymore. If I were to zoom out, you can kind of see, we don't have the pink shading yet either, which is what you need with the 3rd red arrow. We've had 3 green arrows for so long. We got the 3 green arrows back in November the 11th, so it's been 3 months now. We've been in this 3 green arrow period. That's a pretty long period. I think there's a pretty decent likelihood that the next set of 3 red arrows might be the bull tag that starts the bearish move to the downside. You can see that here as well on the when you break up those lines. You are below the 200-day moving average. Eventually, I don't know why I went back to SPY there. You are below the 17-day moving average. You already had been in the convergence period for a while. Now you're potentially breaking below, but you notice we're so bullish that there's some pretty decent gaps in volume here. You're so far above the value area. That's 70% of the volume. So that means 30% of the volume's outside of that, and most of that 30% is going to be up here. But that's not very much, which means there's not very much support to the downside on a stock like this. You can see on the weekly chart, again, that MACD is really rolling over. Stochastics and about as high as it's at. It's not below that 8-week moving average yet. Let's look at some of the other oscillators for NVIDIA, which had gone pretty strong parabolic over here, has been gradually moving up as the ADX has been falling. Now your negative indicator is above 20 again. It's done this a few times and bounced up, but a little different pattern this go around on the chart itself. Looking at the RSI and the CCI, you can see they're not at bullish levels anymore, below 60, below 0 on the CCI down there. Looking at the, let's see here, the Ichimoku cloud, obviously you're well above the cloud, very, very mature bullish trend, very strong rate of change. You are breaking that green line there. This is what really stands out to me too, is the bandwidth, as bullish as we've been, and really riding above the Keltner channel this entire time, but the bands have now dropped to really, really low levels. The 150-day low, new 150-day low. You're at the midpoint of the range. You're not in the upper quartile anymore, and the bands have come inside the Keltner channels, which again is potentially a transition point. Now, we've done this before and continued higher, but again, considering the broader market being close to their own resistance levels, and you can see the stock itself, if I were to get back to kind of a longer term chart, as bullish as it's been, being at its resistance level. In fact, I wanted to show the rate of change. You can see, how far, how bullish we were. We were in the 90th percentile and above in terms of how far we were above the 30-week moving average. That led to some, that's how far it got before this whole correction started. That's how far it got over here before it just went sideways for a full year while the market itself remained relatively bullish. Again, if the market can't remain relatively bullish and it starts a new leg lower, NVIDIA is not in a good position from a margin of safety standpoint. So you can see the weekly, getting multiple weekly clusters here, and then now the momentum line really breaking down to the lowest level of this bullish move, and the near-term line breaking back below 50 here, which it hadn't done for quite a while since that little bearish run there. So again, you can kind of see the stars aligning. But still, as bullish as it is, it would be a very speculative move. And so I wanted to stay speculative here and go out to, relatively far away from the where we're at right now by May expiration. Still one standard deviation, inside the one standard deviation window, but right on the cusp of it in order to get a pretty good reward to risk ratio. So about a little bit more than what would that be, a 4 to 1. Let's see here, it'd be 20, 50, about 450, about 4.5 to 1 reward to risk ratio. So I like that reward potential if the speculation works out. And if it doesn't work out and we just kind of grind, then I can keep the risk really small. And at the worst case scenario, again, almost 5 times less than what the potential reward was. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Also, join our website at marketscholars.com for free. Follow us on Twitter and Facebook. Like our content there. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.